aboard Saurabh Mukherjea and ask him about what he's making of the markets right now. Saurabh, hi, morning. Great to have you on the show. Saurabh, how's the market looking like from your lens, with West Asia still in limbo, crude back to 92? But the internals, be it earnings or the high-frequency data, that seems quite encouraging.
I think this has been the best earnings season, Aisha. I think in 3 years, this has been the first time I think I've seen Nifty earnings growth cross double digits. And I reckon the September quarter as well, the July, August, September quarter also looks good. The tax cuts that were announced last year, the rate cuts of last year, those are clearly bearing fruit now. The combination of good earnings growth with sensible valuations for quality stocks, I think quality is at its cheapest in 10 years. That combination, I think, is very tasty. We're seeing the beginnings of FII interest return in the Indian market. Long may this last. These are early signs, but this combination of strong earnings growth, not just in small and mid caps that had been there for a while, but strong earnings growth even in large caps, sustaining through to the Diwali quarter, hopefully, and then combine that with attractive valuations, the return of FII interest. This is the sort of chirpiest I've felt about the Indian market for the best part of 3 years.
But unfortunately, Saurabh, that's not quite reflecting as chirpy on the index, right? And I guess the index, because of the IT and the kind of weightage that the BFSI segment holds, isn't quite the true picture. Having said that, when is it that you see a meaningful move come in at an index level? And when is it that you see the FPI money actually return consistently? It's definitely come back a lot better from the March lows, but you're not seeing a very consistent or meaningful up move.
So Aisha, I think there's a broader point that we've been reflecting on in Marcellus for the last couple of years, right? The broader point is the index has become a little skewed in favor of lower quality names. Remember, for 4 years, high quality was hammered. 22, 23, 24, 25, high quality names were hammered, and it's natural, therefore, that the index now has a higher weightage towards lower quality names from the PS universe, from the metals and mining universe, from the construction universe. And I think at the index level, in terms of share price action, I think the going will be choppy. So the best comparable I can give your viewers is the period from December 2007 to Jan 14. For a good 7 years, the index gave zero returns in our country. So Nifty 50 returns, December 7 to Jan 14, index level returns were close to zero, but quality companies compounded comfortably at 15 to 20% per annum. I think we're likely to see a similar period in India, where at the index level action will be tough because the index itself has low quality names, where share price action will be hard to generate. But at the quality end of the spectrum, I think you're likely to see sustained up moves over the next 2 to 3 years as we feed into this consumption recovery, as we feed into the export-oriented recovery, as the rupee weakens further and manufacturing exporters do well.
Saurabh, hi, this is Harsha. I do know that you have investments and a view with regard to paints, and it seems like we've started to come off the lows in terms of the cycle. And last year was, to some extent, a difficult year. Q1 has actually surprised for the first time in a while. Do you expect things to turn around? And what do you think is driving the traction? Can it sustain?
I think there's two things to consider here. One is the entrance, right? My view was sustainably through the last 4-5 years that the entrance simply wouldn't be able to compete with incumbents like Asian or Berger. We've written extensively, spoken extensively. In fact, exactly 10 years ago, we published The Unusual Billionaires, where we explained why Asian Paints and Berger Paints are such formidable companies to compete with. And for those who want to know more, just go and read that book. I think the publisher Penguin is going to launch the 10th anniversary edition of why it's so difficult for others to compete with Asian Paints. So there was a sort of a scare in the market that new entrants would be somehow able to dislodge Asian Paints or Berger Paints from their market share. I couldn't quite understand the logic behind it. So that piece was anyway going to fall flat on its face. The broader challenge, though, the sector itself had stopped growing. For the first time in living memory, paint volumes in India had stagnated. As you're rightly pointing out, the worst of that is behind us. The 0, 1 or 2% volume growth for the paint sector, which were unheard of volume growths for the sector. That story, that scare is behind us. So with the sector growing volumes at, say, high single digits, and with the competition, the new entrants finding the going really hard as incumbents like Berger Nation, the names you're flashing up on the screen, as they exert themselves, I think we're beginning to see the return to normality. That being said, even now, I think building materials, high quality building materials plays. There is juice left in them. These are companies with deep moats beyond Asian and Berger. There are other companies we own in the sector, such as Astral Poly. There's strong moats around these firms. All of these firms we have written about extensively exactly 10 years ago in Unusual Billionaires. And these companies have stood the test of time over the last decade, both on fundamentals and on market cap action. They have beaten the benchmark, and I think that the signs look pretty good for them over the next 10 years. So the year-to-year noise around competitors coming and going, that's bound to be there. People like us look through that. But what had perturbed me through 23, 24 was the sector had stopped growing, the paint sector. Good to see that story behind us. The tax cuts, I think, have worked. The rate cuts have worked. Paint sector volume growth is back to where it should have been, around the high single digits.
Sort of the other piece that you kind of touched upon was how quality hasn't done as well. When does the cycle there turn? Because it's been a very painful ride for those who've been sitting on quality names within the Nifty basket, right?
So that cycle has turned, right, which is why, as I said, I'm feeling chirpy about the market. So this year has been a bumper year for us. So this fiscal, I think we're up 23, 24% in most of our funds because of the quality comeback. As you're rightly saying, Harsha, 22, 23, 24, 25. For 48 months, 50 months, quality got absolutely thrashed, right? So there's an index called the Nifty 200 Quality 30. It's not an index created by Marcellus, just to be clear. It's an index that the NSE has created. The Quality 30 is a good proxy for quality. And Quality 30, I think, underperformed 4 years in a row for the first time in its history. And we obviously faced the brunt of it given our investing style. But this fiscal, that style of investing is back with a bang. The names that we're discussing are doing well, both in terms of EPS growth and in terms of share price action. And given that we've never seen a 4-year thrashing for quality before, I'm hoping that that aberration is behind us and that we now have a few good years for quality. Another way I was framing the situation for your viewers, which is that this looks to me to be a very similar set of circumstances as we found ourselves from December 2007 to Jan 14. At the market level, difficulty in seeing big signs of upside. But at the quality end of the spectrum, just like 2007 to 14, I think there's a good chance quality names will compound at 15 to 20% per annum going forward.
And where is Saurabh Mukherjea spotting the 30 to 40% alpha generation?
So 30 to 40%, we are loading up on exporters, Aisha, in our small cap portfolio. As I said in my previous call with you guys, I think the rupee bursting through 100 over the next year or so is more likely than not. The combination of a weakened rupee, the FTAs that the government has negotiated with UK and Europe, plus China plus one. China plus one is for real. We think Indian exporters, manufacturing exporters will do well. So we are loading up every day in textile exporters, auto ancillaries, precision engineering companies, pharma ancillaries, and then finally the pharma companies themselves. I think we're going to see a sunrise for Indian manufactured exports. For most of your and my lifetime, Indian manufactured exports have flattered to deceive. I think this time around we'll see a proper sunrise for Indian manufactured exports. So if somebody watching wants to make more money than can be made from consistent compounders, then have a look at manufacturing exporters.
Interesting. And I want to talk about these individual sectors one by one, Saurabh. Let's first pick up on pharma, because a large part of the rally has already taken place. But tell me, where can you put fresh money to work? Or again, would you say for pharma, that basket approach would still work very well?
So look, I think leaving aside formulations, place in pharma where we got very excited 3-4 years ago was CDMO. So this is the outsourcing of clinical research, drug development, manufacturing by big pharma companies in the Western world. We got very excited because China plus one 3-4 years ago became a big thing to our mind. And we realized that China is 10x larger than India in all of these activities with vis-a-vis big pharma. And having spoken to big pharma companies in the Western world, having spoken to consultants who advise the US drug regulator, we were very confident that loading up, for example, on Divi's lab was a good idea. But now we're seeing the CDMO boom spread beyond Divi's. So we've been long-standing shareholders in Divi's. I think we've held it for 7 or 8 years. It's made a lot of money for us. Hopefully, it'll continue compounding for us in the years ahead. But I think the CDMO boom will become a much bigger boom. Divi's is doing well, but I think other CDMO companies are also likely to do well in the years ahead as the China plus one story spreads beyond Divi's. Then if as CDMO takes off, the suppliers to firms like Divi's, right? So suppliers to firms like Divi's will also do well. So we've been long-standing shareholders in a firm called Acutas, ACUTAAS. So they supply raw materials to Divi's for their APIs. So there is a broader pharma ecosystem supplying into the CDMOs that I think will do well. This sector, as I said, we are 1/10 China's size. Even if we take 10% share from China over the next 3 years, this sector potentially doubles in 3 to 4 years, with obvious implications for share prices. And similarly with textiles, right? Bangladesh exports 3x India's textile volumes because Bangladesh gets a tariff break vis-a-vis Europe. From January next year, that tariff break goes away. We and Bangladesh will have parity. Even if we close the gap with Bangladesh by 50%, I think there's a good chance Indian textile exports will double over the next 3-4 years. And again, obvious implications for well-run textile manufacturers.
Quick follow-up on Divi's, Saurabh. You've obviously loaded up at lower levels. Would you still at these valuations feel positive with regard to a stock like that? I know you don't give stock recommendations, but just
that's a daily discussion in the Marcellus investment committee. As you rightly picked up, there's pros and cons to that. There's enough people who will say that Divi's at these valuations, I think whatever 65 times forward is rich. It clearly is rich. The question is, can it sustain 20-25% EPS growth? Our view is it can sustain, and therefore we are maintaining a punchy position in Divi's. Just for those who are watching, right? This is not for the faint-hearted. In the 8 years we've held Divi's, it's tripled on us, halved on us, tripled on us again. So if you can't live with 50% drawdowns, then perhaps best idea is not to listen to my interviews. So if you want to do this sort of investing, then have the stomach for a 50% drawdown, because great companies will go through 50% drawdowns, whether it's Bajaj Finance, whether it is Asian Paints, whether it is Divi's. Great companies have this pattern where they double, triple, quadruple, and then they have a 50% drawdown. And again, they double, triple, quadruple. So the test of your nerve is when the stock gets absolutely trashed, can you stay invested? We've lived through that test with Divi's, but our sense is it's worth holding on to Divi's. Unless there's some desperate need for cash, we'll try to sustain our investment at Divi's at fairly punchy levels.
You know, the other one, and this we're absolutely not used to seeing drawdowns and deep drawdowns on, Saurabh, is HDFC Bank. What do you make of it? I know you're invested, but what do you make of everything that's playing out over there? Every day you've got some news coming out. I know you're the patient kinds, but how do you view it on a day-to-day basis as new developments continue to shape and obviously influence the stock price as well?
So part of the challenge of the job is to cut out the day-to-day and not lose too much sleep on it. We get the signal from where the signal emanates. We spend a lot of time at the ground level speaking to branch managers of various banks, not just HDFC banks. We speak to both customers, DSAs, people who originate loans for the banks, and we speak to branch managers of various banks. And our reckoning is at the high street level. This bank, HDFC Bank, continues to dominate, continues to rock. And hence we've stayed steadfast in our investment with the firm. Again, in Unusual Billionaires 10 years ago, I wrote about it as to why this bank is very difficult for competitors to take on. So if you notice both sides of the balance sheet, both on the liability side and on the asset side, it's been very difficult for competitors to mount a challenge. Yes, there are rumblings about governance. Yes, we have the erstwhile chairman discontented about certain things in the bank. but our view remains that this is the quality act in Indian retail banking alongside ICICI Bank. And a lot of credit to Sandeep Bakshi and team there. Alongside ICICI Bank, HDFC Bank is the class act in Indian banking. As we, at some stage in the next year, we will have to begin a rate cycle in India. The Western world, I think, has already begun its rate cycle. The ECB has started hiking. We will have to begin a rate cycle, up cycle in India. As the rate up cycle kicks in, I think the men and the boys and the women and the girls will separate in Indian banking. And that's where I think it's most likely that people will understand and appreciate the merits of a bank such as this.
Well, just FYI, HDFC Bank, like Harsh just flagged off, is sub 720, by the way. 718 is where the stock is right now. So let's see. It's surely testing patience of a lot out there. But Saurabh, great to be chatting with you as always. Thanks for your time.
Thank you so much. Thanks, Aisha. Thank you.